Hi and welcome to Swiss Codes Daily Market Talk. It's Friday, February 28th. Nvidia's failure to whet investors' appetite with another record-breaking set of quarterly results on Wednesday, and the renewed tariff fears from Donald Trump hammered market sentiment yesterday and sent most major indices on both sides of the Atlantic Ocean lower. But the European defense stocks and the US dollar gain obviously, and on the data front the US growth data came in line with analyst expectations, but the price pressures in the US in the fourth quarter were higher than expected. So today all eyes are on the US core PCE data, which is the Fed's favorite gauge of inflation, which is also expected to ease some of that worry with softening inflation pressures expected to be printed by that metric in January. Okay, so as suspected, despite beating both revenue and earnings expectations and the forecast for the current quarter, Nvidia actually got beaten by the market yesterday. The share price tanked 8.5% in yesterday's post-earnings trading session, took out the 200-day moving average and closed near the $120 level, which also matches the minor 23.6% Fibonacci retracement on the AI rally. So the stock remains in the bullish trend, of course, from a technical perspective, following a more than 900% surge since the beginning of 2023 on AI optimism, and will also remain in the bullish trend above the $100 per share level, which beautifully matches the major 38.2% Fibonacci retracement that could actually distinguish between the AI rally and a medium term and a more persistent pullback. But the short-term direction does look bearish right now, with trend and momentum indicators hinting at the possibility of a deeper pullback in Nvidia's share price over the next few days and weeks of trading. And while Nvidia was bearing the brunt of having fallen short of the most euphoric analyst expectations this Wednesday, well, Amazon revealed an update to its Alexa, which now uses artificial intelligence to answer a question. So the company also announced to have built its first quantum computing chip. That may not be excellent news for Nvidia, obviously, but even Amazon fell yesterday by more than 20.5% on the kind of news that, well, could have easily triggered a rally if the market mood was better than the one that we had yesterday. Salesforce results, on the other hand, also fell short of market expectations and further weighed on optimism that their AI product would boost sales. So CRM is also on its way to test an important critical support range between $275 to $290 area, including the 200-day moving average and the major 38.2% Fibonacci retracement on the AI-boosted rally since the beginning of 2023. And one bright spot this week was Snowflake. The company actually forecasted a better than expected revenue growth thanks to its AI products, and also expanded a deal with Microsoft's Azure to give access to OpenAI services. So the share price jumped open yesterday, but it couldn't resist to the overall selling pressure in technology stocks and spent the session giving back the early gains. It still closed some 4.5% higher, but it could have been better. And Microsoft lost 1.80%. So overall, Nvidia's failure to satisfy the now increasingly harder to satisfy investors weighed on the market mood yesterday, along with some new tariff talk, confusion, and news from Donald Trump. So the tariff man said that he would still go ahead with tariffs on Mexico and Canada as soon as March 4 or March 2 or something like that, but hey, his colleagues found that it was clear enough. What was also pretty much clear to everyone was his plan to impose 25% tariffs on EU imports Details will apparently land soon, and we can't wait. So the European Stoxx 600 index eased yesterday, not by much, but by around 0.46%, but eased still. The DAX index lost more than 1% as the German car makers will almost certainly be very much concerned by the 25% levies that Donald Trump is referring to. But the European defense stocks, on the other hand, continue to see strong demand. In the sense, the BAE Systems rose near 3.5% yesterday. Rheinmetall gained 3.5% as well and traded at a record high level. And Leonardo gained nearly 4% as well and hit a fresh all-time high level too. Meanwhile, the British PM Keir Starmer met Donald Trump in Washington yesterday to try to smooth things over between the two old friends, and he probably did better than Emmanuel Macron earlier this week, who actually couldn't prevent the announcement of these 25% tariffs on the EU products hours later. As such, the British FTSE 100 index was standing out at yesterday's trading session as the index eked out some gains as its European peers were hit by the new tariff fears. In the FX space, the fresh tariff threats from Donald Trump hammered both the euro and sterling, while the euro dollar slipped below the 104 psychological level and is testing the 50-day moving average to the downside at the time I'm talking here this morning, and that despite higher than expected Spanish CPI update released yesterday morning. Now, more of these CPI updates are due today from France, Germany, and Italy, but the economic data could eventually remain under the shadow of the tariff talks and fears, meaning that potentially stronger than expected CPI numbers from the European countries may not weaken the European Central Bank interest rate cut expectations, as the tariffs and their negative implications are expected to hit the European economies to give the European Central Bank enough reason to give a decent support to the underlying economies. Across the channel, cable slipped below its 100-day moving average yesterday, and the bulls abandoned the fight near the major 38.2% Fibonacci retracement front on September to January Trump-led sell-off, and the pair is now preparing to close the week without having successfully reversed the bearish trend against the US dollar. The dollar yen, on the other hand, is testing the 150 psychological resistance on the back of a broadly stronger US dollar and also on the back of the weaker than expected inflation numbers that just came in this morning in Japan. And you want to laugh? The latest Marvel movie pictures US entering in war with Japan, apparently. Anyway, even gold fell at yesterday's trading session faced with a stronger US dollar. The price of an ounce of yellow metal slipped below the $2,900 level. While a pullback after having flirted with the $3,000 psychological level is healthy, the outlook for gold remains positive in the medium run on the back of the very much tense global geopolitical environment of the moment after only a month and so into Donald Trump's 4-year term. On the economic data front, the US GDP data yesterday confirmed that the US economy grew 2.3% in the fourth quarter of last year, as expected, but the price pressures were stronger than penciled in by analysts. Initial jobless claims, on the other hand, hit the highest level since last October, with a very visible rise in Washington's jobless claims. Because federal workers there are being thanked en masse by Elon Musk's Doge departments. Will the latter soften the Fed policy outlook and increase bets for more rate hikes this year? It depends. It depends on the inflation's trajectory. Of course, due today, the US will be revealing its latest core PCE data, which is the Federal Reserve's favorite gauge of inflation that could eventually show some easing in inflationary pressures in the month of January. If that's the case, we could maybe, but just maybe, see the US indices recover a part of their latest weakness. We will see. In all cases, the Donald Trump optimism is fading. Appetite across the globe has become very much fragile in most risky assets, and volatility has been rising this week as well. And remember, we tend to have higher volatility in bear market conditions, as stocks are generally more synchronized when sold than when bought. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.